There we go. So I've shared this, well, for weeks and weeks, months on months. I think it started in October. So 3 months there and 4 or 5 months. So really building up a nice amount of data in the live market on this account. Invariably, drawdown is it's probably one of its highest, 1.7%, but it never goes above 4 or 5% drawdown. Trades are very low, 172 trades in the past 7-8 months. If you pro-rata that and work that out, that is not many trades. So I can take this portfolio and use it across various different accounts. So this is also feeding the PAL copy trades. It's feeding various different challenges, Darwin X, etc., etc. So you can see here, even in isolation, if I ran this in isolation, it's a nice, steady, consistent performer. This would have passed any prop firm account over 2-3 months, which is nice. So 33% up overall on that one. Gold long term, nothing open on this. It's paused for news. Again, 7 or 8 months of data in the live market. So once you do this, there's some people in the chat right now who have built a portfolio, banged it straight on a challenge or funded. Yes, you've done some due diligence with building the portfolio, but you still haven't seen that play out in the live market. Leaving something in the live market, even if it's just for 2-3 weeks, and getting an idea and a flavor for how it runs, is really going to help you, judge drawdown profits. I've built a I'll show you. I've got one coming up. I've got one portfolio that's made way more than I thought, but it also had more drawdown than I thought. If I hadn't have ran it in the live market before I consider running it and how I run it, I could have had a drawdown issue or hit a max loss of a day, etc., etc. So the live market, nothing's going to beat that, and it enables you just to make educated decisions in how you then structure your slave accounts. So I think it's fundamental. This here is only a 0.3 lot size, very low lot size, 2 to 3% a month. So that's since the end of September as well. So this is just solid. The fact that gold has been so volatile in an uptrend, we've only been buying. When it dropped, we had to wait for the 4-hour to close below the EMAs and the ADX to suit it, to match it on a lower time frame for us to have any sells. We've had some sells recently, but whilst gold's been sort of lacking a little bit of direction and been consolidating a little bit, we've also not had much trade volume because we're waiting for the mechanical rules and the conditions to be met, which is just what mechanical rules, algorithmic trading is all about. There's no FOMO, there's no rushing into a trade based on emotion. If the conditions and rules aren't met, nothing's going to happen. But when they are met, it's going to happen flawlessly and it's going to execute every time. Whereas a manual trader might be trying to force a setup that isn't there because they're bored and they're looking for an ROI on screen time or they're getting FOMO. But likewise, when their setup does exist, they might also get fear that they might have just taken some other losses and then they might not execute flawlessly because they're worried about this setup might not play out because the other ones in their plan didn't either. Or they might then risk more, or they might miss the setup altogether. So this is, the biggest benefit of when your setup plays out and you're trading the way we do, it's just going to happen. Yeah. So if we look at the closed trades, the uptrend on gold finished around the 19th, 20th. Took a few days. I don't know if that was the weekend or whatever. Obviously, there was the war thing, and then it died down, and some of that uncertainty was priced in on the Friday. And then we've been entering in sell trades since then. And to be fair, as you can see, none of them's gone into a big stack of trades either. I think the biggest sequence I've had is a 4. So very low drawdowns since then too. This has been running for a very long time. This is just very old school hedging and averaging strategies that you wouldn't really be able to run on a funded account unless you ran it really low lots. But I use this on live capital, and I'm also using it in a sort of way on my Darwin X on really low lot sizes too. But what you can see here is this is from 2023. Compounding wasn't on. I didn't scale up the lot size. So what happened there is we had a big chunk of profit, and then that's just dropped month on month because the balance has grown and the equity's grown, but I hadn't scaled up the lot size accordingly. I then amended that in April and upped my lot size. Well, I doubled it, but it still wasn't in relation to how I started the account from day one. So these sorts of accounts always have drawdown, which I'm fine with as long as you understand that, because ultimately, yes, I'm in drawdown, but even if I just looked at my equity position, it's still 6 times greater than the 100K it started with. My balance is 748. So if I wanted to close that out now, I'm still way up on where the account started. So, you know, that equity percentage, I might always have 15 to 20% drawdown, but if my equity keeps going up, I'm not really bothered. Yeah. Same with this one. This has, I think, a higher delay, which actually hasn't worked out better. It's actually made less, and I have more drawdown than the other account. So it's quite interesting. What I've done there is I've backtested 2 concepts, and I've now got data-driven decisions off the back of it. I know categorically over the period of 18 months, 15 months, 15 months, what's worked better, because when you remove a lot of the technical indicators that help a trade open or not, whether it be RSI, trend, ADX, being able to backtest hedging and averaging style strategies is almost impossible because every minute is unique. If I started a back test at 10 o'clock and started one at 11 o'clock, I'm invariably going to be in a different stack of trades, potentially. It depends how the markets have moved. But those things are going to happen from time to time. Another thing to note with these strategies are they are fixed lot. They are not martingale strategies. They pause for news. And yeah, I mean, to build that amount of live data in the market gives you a very high level of confidence and a very high level of awareness over drawdowns and the amount of moves we've seen in the market over that last 15 months, right? We've seen huge dollar moves, and these are all dollar linked pairs. But the way it moves, sometimes I might be in some drawdown and a buy sequence on GU and a sell sequence on EU, just due to the nature of how positions are built and how they've closed. So that's quite an interesting concept as well. So this was a portfolio I built literally at the end of March. Looking at major pairs, looking at trend strategies, ranging strategies against trend strategies, and building a diversified portfolio based on major pairs. So as you can see right now, I've got nothing open. It's made 20% in a month. 660 trades, 80% win rate, blah, blah, blah. Not that that really means a lot. But what the point I want to make here is this made far more than I thought, but I also had more drawdown than I thought. So how I would choose to, I'm going to just watch this account for another month. And if I choose to copy this to a slave account, I'm going to reduce the multiplier on it. So as soon as I start copying this, I might copy it at 0.3 or 50% of the true risk to reward that this account is currently on. This one, on the other hand, I also built a portfolio based on miners. And this is playing out pretty much bang on where I thought. Drawdown has been probably 1 to 1.5%, 4.7 profit in the first month. So I can now build a slave account or another portfolio combining these 2 accounts. The majors account I could run at much smaller multiplier, and this account I could keep as is. And then I've got 2 portfolios into another account to create a new portfolio. And if I wanted to, I could add the gold account in, I could add AUD CAD account in, etc., etc. This is another account that's been running 8, 9 months, 1, 2, 3, 4, 7 months. NZD, CHF, AUD, CAD, steady equity curve. less than 1% drawdown right now on some trades. Small bit of martingale, but the lot size does cap. Again, another option to bring into the mix. Now, this one isn't one of my favorite portfolios because there has been a couple of times where drawdown has got to 4 to 5%. And when you look at that from a CAGR ratio or drawdown to overall profit, this is a lower performer compared to some of the others. Now that ratio, so when I'm looking to build a portfolio on Portfolio Builder, if I put, say, 1,000 maximal drawdown in, I'm looking for stuff that, in terms of profit, that is at least 5K to my 1K risk. Sometimes I might get 10 or I might get 12K to my 1K risk. And when you look at the CAGR score, that basically takes into account the annual rate of return versus the maximal drawdown of a strategy. Now, hedge funds use it, and ideally you want to be looking at 3 to 1, 5 to 1, 7 to 1. So when you can take all that data and pull it together, like I've even shown you right now on the live market, you can build a very healthy CAGR ratio of overall annual return versus the maximal drawdown of your overall portfolio or individual strategy. It's just something that I've been subconsciously doing on Portfolio Builder, but probably not talking about that as a ratio or as an industry statistic that hedge funds and people like that use. So if I look at our PalCopy master account, the CAGR ratio on this is phenomenal because we've made 22K in 8 months, 6 months, 7 months, and the overall drawdown on this has not been above 3.5 to 4%. So, again, data built in the live market, trading, I think it's 3 pairs, ADCAD, EU, GU. And then this account goes into the PalCopy trade, which is here. So again, 23% up, really good. April, I've just launched a referral scheme on that as well. The details are in the channel. If you're a member of this and you mention it to a friend or whatever and they get connected too. So yeah, a good run through of a selection of accounts. Now the first question in the Q&A is how to do the bulk copy thing. So whilst I'm sharing